Hello and welcome back to Financial Freedom Hub, the channel where you can learn how to analyze any company's balance sheet and find the best investments for financial freedom. Today we will talk about long-term debt, which can tell us a lot about the company's economics. In this video we will reveal two simple rules from the greatest investors like Warren Buffett, for you to follow. If you follow these simple rules, you will make good investment decisions, with confidence and peace of mind. If you are new here, you might want to subscribe to our channel, and turn on notifications, in order not to miss our new videos. Long-term debt is the amount of money that a company owes to its creditors that is due more than 1 year from the date of the balance sheet. It can include bank loans, bonds, leases, and other obligations. As we are looking for investments that can make us financially free, the first thing for us to know is that companies with good economics never need to borrow a lot of money to finance their expansion or acquisitions. This is because they can finance their business from their profits. So, the first rule goes like this: for financial freedom, look for companies with no or little long-term debt. The way we measure how well a company can handle its long-term debt is to compare it to its earnings. Earnings are the amount of money that a company makes from its operations, after deducting all expenses. But remember, a single year is not enough, we should look at the numbers of 10 years. A general guideline is that at any given year, the company's earnings should be able to cover all their long-term debt within 3 to 4 years. This means that if the company used all its earnings to pay off its debt, it would be debt-free in 4 years or less. So, here comes the second rule: for financial freedom, look for companies whose earnings can pay off their long-term debt within 3 to 4 years or less. And remember, this should hold true for every given year, for the most recent 10-year period of earnings and balance sheets. Let's look at some examples of companies that have different levels of long-term debt and earnings. One company that has very little long-term debt and high earnings is Apple, the maker of the iPhone, iPad, Mac, and other popular products. As of September 2020, Apple had $98.7 billion of long-term debt. Its earnings for the fiscal year 2020 were $57.4 billion. It means that the company could pay off all its long-term debt in less than 2 years. This tells us that Apple has a very strong balance sheet and a lot of financial flexibility. Another company that has low long-term debt and high earnings is Starbucks, the global coffee chain. As of September 2020, Starbucks had $14.7 billion of long-term debt. Its earnings for the fiscal year 2020 were $928 million, which means that it could pay off all its long-term debt in about 15 years. However, this was a very unusual year for Starbucks, as the COVID-19 pandemic severely affected its sales and operations. In the previous fiscal year, 2019, Starbucks had earnings of $3.6 billion, which shows us that it could pay off all its long-term debt in less than 4 years. This tells us that Starbucks has a relatively healthy balance sheet and a good track record of profitability. On the other hand, some companies have high long-term debt and low earnings, which can indicate financial distress or risk. One example is AT&T, the telecommunications giant. As of December 2020, AT&T had $153.8 billion of long-term debt. In 2020 they had net loss of $5.176 billion. Its earnings for the fiscal year 2019 were $13.9 billion, which means that it would take more than 11 years to pay off all its long-term debt. This shows us that AT&T has a very heavy debt burden and a low margin of safety. Another example is General Electric, the industrial conglomerate. As of December 2020, General Electric had $70.3 billion of long-term debt. Its earnings for the fiscal year 2020 were $5.2 billion, while in previous years, the earnings were negative. It would take the company 14 years to pay off its long-term debt. This clearly shows us that General Electric has a weak balance sheet and earnings. As you can see, long-term debt can have a significant impact on a company's financial performance and outlook. Companies with low long-term debt and high earnings are more likely to have good economics and durable competitive advantages. These are the qualities that we are looking for to achieve true financial freedom. On the opposite, companies with high long-term debt and low earnings are more likely to have poor economics and weak competitive positions. However, there is one more thing to know. Good companies are often targets for leveraged buyouts. A leveraged buyout is a type of acquisition where the buyer borrows a large amount of money to buy a company, using the company's cash flow as a collateral. As a result, the company's balance sheet will be loaded with a ton of long-term debt. In these cases, the company's earnings will be focused on paying off the debt and not on growth. If this is the case, then you might want to buy the company's bonds instead of common stock. So, let's wrap it up. Here are the main takeaways for you from today's topic. 1-year earnings and balance sheet is not enough. Look at a 10-year period of earnings and balance sheets. Look for good companies that have no or very little long-term debt on their balance sheet. Compare earnings and long-term debt, and make sure that the company, in any given year, is able to pay off all their long-term debt from less than their 3 to 4-year earnings. We hope you enjoyed this video and learned something new about long-term debt on a company's balance sheet. If you did, please give it a thumbs up and subscribe to our channel. Thank you for watching, and we'll see you in the next video.